much for being here. I am David Mullings, founder, chair, and CEO of Blue Holdings. We have a special purpose vehicle focused on allowing retail investors to invest back into the Caribbean. And I've been asked to moderate this panel, and I think most of you will have some very important questions. And we have a distinguished group of panelists. I'll let them each introduce themselves when I ask the first question. But here, we're going to be talking about fundraising strategies for venture capital funds. So just so we know who's in this audience, how many people in here already have a venture capital fund? Just raise a hand if you already have a fund. All right, so very few people. How many people are LPs in a fund? All right, a little bit more. How many people want to launch their own venture capital fund? All right, so this is really for you. So make sure you have your questions and then find all these people on LinkedIn. So I want to start on my right. Miriam, I'd love for you to just give us a little introduction. And then the question I would want to put towards you is, what are strategies to help build trust with LPs?
Very important question. Thank you so much for moderating this panel. So my name is Miriam Lazarte. I'm the CEO of Global Startups and GP for GEC Ventures. I've been working with startups since the last 9 years. 300 startups have passed through our programs, and 2 of them became unicorn, and that was trigger our venture capital firm. Like I started just recently because of them, and because we have good startups, and what we do is basically Moneyball. That's our strategy, is Moneyball. So the trust part is really important, especially when you guys are going to be first-time managers. First-time managers, you can have all the track record, experience and all that, but it's the first time that you're managing money for LPs. It comes to a really difficult conversation and how you're going to return the investment for those that are trusting you. So I would say, like, part of that, is entering into first connections in your network, people that know you from long time, that have reference of you, of your work, and they maybe have the same vision and the same passion about what you are doing. That helps, of course, with the trust. And this is like having any other company. You just have to have a plan. You have to have, a vision in how you are going to end up your fund and what type of startups are you going to have there. So it's a lot of components that you have to put in place for people that are interested to join you as LP in a fund. And consider that, I've seen the statistics, and probably some of you that have venture capital funds, about 75% of the funds fail. This is a really bad time for venture capital. I think that's a conversation we can have. Syndicated funds have been raising in the last years, and we have taken approach a little bit like syndicated approach, but it's a venture capital because it doesn't make sense for us to have syndicated. But you really have to change the strategy because many LPs are not necessarily trusting right now the market.
No, well, thank you for that. I want to move on to Vernon on my left right here. So same question. How did you build trust with LPs? And what got you into venture capital as well? We heard how she got in and her why. What even got you into VC?
My path was very, very different. Again, thanks for having me, and I think this is a very important conversation. I'm one of the managing partners for Lightship Anchor Fund. We're raising a $2 billion targeted global fund to invest in emerging venture managers, as well as invest in later stage Series B, Series C companies in the US, Africa, and Europe. And so my path was very different. I actually started out as a US Air Force officer in acquisition, doing project management, working on satellite systems, simulators, and trainers for pilots. Later, director of PricewaterhouseCoopers, working with startups and global companies. And so a very different path, and then later co-founded the Marathon Fund, an early stage venture fund investing in fintech, edtech, and digital media. But while I was at the Marathon Fund, my other co-managing partners had their own funds as well. And what we were seeing when we were collaborating and syndicating deal opportunities, what we realized is that there was a gap in the marketplace. So there were institutional investors, there were family offices, and large LP allocators that wanted to write minimum check size 50 million, 100 million plus, but there was really no vehicle. There were not as many vehicles focused only on venture in order to allocate that. So we each left our own individual funds to form Lightship Anchor Fund to be able to have a platform for those family offices, institutional investors, particularly the public pension funds and even DFIs, to invest in a platform in which they would get the same fund economics in terms of management fee and carry as if they went direct, but with the downside protection as a fund-to-fund, as a portfolio effect with enhanced venture returns. In terms of building trust, we've collectively just been in the venture ecosystem for a number of years. And so our investment track record certainly has helped, but also being in the community. And when I say in the community, not just in Silicon Valley, in New York or Boston, and nothing against those wonderful locations, but being in the Midwest, for example, being in Detroit, being in Cincinnati, and being in places where there's amazing venture activity and underlying entrepreneurial ecosystems that are taking place, that's how we've built trust over time and really engaging with LPs and having alignment of both mission and return standpoint. And then the same thing in Africa as well, where we're primarily focused on Egypt, Ghana, Nigeria, Kenya, and South Africa as those hubs for venture and later stage investing.
Okay, so you heard, get in the ecosystem is important. Network, getting them out there. I love that. So one, same thing to you. How did you get into VC? And how did you get the trust of your LPs?
Good question. And first of all, I would like to say that, and this is a spoiler alert, that there are no recipes for the topic that we are having today. So this should be like a workshop, kind of trying to listen your thoughts regarding the topic. But I think that it's never enough, like I'm a fund manager, but I have been an entrepreneur. I have lived in Brazil for 3 years. I have lived in Mexico for 2 years. I have traveled around Latin America for the last 15 years. And even though I work in big corporations as well, I led the VC Association and Private Capital Association. And it's like we are always trying to catch up because we are always trying to be the best in the room. And conversations with LPs that are exposed to a lot of great entrepreneurs is quite difficult. So you need to understand that there is an LP for every VC fund. So setting the right expectations is good. And there's a figure interesting that you have to prospect 25 millions in order to obtain 1 million. So receiving a no is not an end game destination conversation, but it's just one step more in the life cycle.
No, I love that. So I want to move on to the second question, and we'll stick with you on and come back this way. You talked about the fact that there's an LP for every VC fund. That's what you just said. So the question is, where are the most overlooked sources for capital, in your opinion?
Most overlooked sources? Well, in Latin America, where I belong, and we are investing in deep tech Latino founders. I think we will talk about that later. We had a lot of exposure to high net worth individuals mainly, and family offices. We are much more close to that because 99% of the VC funds in Latin America are emerging VC. I think we have only 3 that are top great players, which are Monacis from Brazil, we had Kasek from Argentina, and we have Valor, which is US based as well. But the other 99% of the VC funds, we are emerging fund managers, even though I'm raising my 4th fund, and I have a unicorns and a lot of track record. So conversations are still with high net worth individuals, with family offices, with big corporations. And we are trying to, on our 4th fund, to start talking to institutionals and to fund of funds and those kind of LPs.
All right. And so, Vernon, you obviously have been based in a different location. You said not Silicon Valley, not Boston, and so on. You're in the Midwest. What would you say are some of the overlooked sources for fund managers?
And I'm going to answer it a little bit differently, not necessarily by category. Certainly there's family, when you look at the LP base, family offices, high net worth individuals, public pension funds, DFIs, corporate investors, high net worth individuals. What I would say is when you think about overlooked, it's really more about the buying cycles and habits of when they're allocating. And you have to be aligned with that cycle. And so, for example, there's several banks that we're in due diligence with. We started that relationship last year, and they indicated to us that when we first met them, all of their 2024 allocation, their pipeline was full, and that we would be considered for 2025. So you have to understand that buying cycle for that LP. Same thing with family offices. There's a certain mandate. Oftentimes family offices starting earlier in the year, and they're allocating and making commitments. So if you're meeting them in the summer, you're not going to get a lot of activity, especially during the summer. So understanding those buying cycles will help better improve whether you're being overlooked or not. On the public pension fund side, consultants are absolutely critical. And so if you meet a trustee or someone from a staff at a public pension fund at a conference or through another meetup or another opportunity to engage them, they are heavily, heavily dependent on their consultants. So you've got to establish the relationships with the consultants, and then that takes time because you have to get research qualified to be considered, whether it's Cambridge or Mercer. Fortunately for us and our fund, we were due diligence by Mercer, so we're on their platform. We got a favorable rating, but ultimately that took a year to be research qualified and all of the due diligence that went into that. So I would just say this, there's a certain buying cycle to every LP category that you have to align with and be in tune with.
All right, so before I go to Miriam then, I want you to just explain a little more. You talk about the buying cycle, so know your customer and then target that customer. But you talked about consultants. For those who are not, right, they've never been an LP, they've never been a fund manager. What do you mean by a consultant to this pension fund? What is that term? Define it.
So every public pension fund, they have a staff that they're doing due diligence across whatever asset class, whether it's on the public equity side, whether it's real estate, fixed income, alternative asset class. They hire outside consultants like Cambridge, Mercer, and many others to be their arms and legs in terms of doing due diligence on any potential manager for them to consider. And the bigger checks and allocation are certainly with some of the public pension funds, but their consultants are the ones that are the gatekeepers. So they're serving in that capacity for due diligence and essentially extended staff in many ways.
So I love that. They're gatekeepers, and you need to get to know the gatekeepers, understand what they're looking for, establish relationships, and then they can open doors to the pension funds. So Miriam, I want to move on to the next question. How can new fund managers use data to stand out and attract LPs?
Yeah, so in the strategy that we have, we were talking about Moneyball, is building data, basically, you know. And so for those that are not familiar with that, you know, there is a book, there is a movie about that. And why we took that approach is because I'm an outsider in my community. I'm original from Colombia, but I live in Toronto, and I've been building a community in Toronto for the last 10 years. And getting regular LPs, trusting international tech startups landing in Canada was a thing. The only way for them to trust that the company was good, you know, was based on data. Based on data, and you know, I had the opportunity to have my accelerator and having a lot of KPIs with me, and that proved a track record of how we are selecting startups right now. So we don't have to have, you know, very vague conversations about whether this startup is going to be a good one or not. So in particular, I'm working with immigrants tech startups that have landed in Canada years ago. They just landed, you know, recently. These companies are, founders are second, third company, you know, they know what they are doing, but not all of them are investable. So data here becomes a critical part to make sure your LPs are trusting you, right? So initially, I attract LPs that were similar to my startup. So they were also immigrants, but they were, let's say, wealthy immigrants. They made their way in Canada, and they were funding other immigrants. But now we have LPs that, for example, are Canadians, right, but are trusting data.
No, I love that. So we'll start with you and keep going down. How have you been using AI, or do you see a way to use AI? Everybody's talking about artificial intelligence to actually engage LPs or identify companies to invest in, or both?
At this point, I don't need to use AI for just one reason. I have a collective 300 startups in the pipeline, and I know 20 of them that are super good. But going forward, AI could be a really good tool, for investors. And certainly, the majority of venture capital firms that I know, the pain comes from pipeline. And pipeline, not having pipeline sometimes is, having an AI platform or AI tool that can help you to analyze better data for sure will help.
Okay, Vernon, the AI question. Are you using it, or do you see a way to use it for your funds?
We're absolutely using it every day as part of our normal workflow. And again, to be transparent, we're using ChatGPT. We're using ChatGPT Pro. And so it's more of a closed loop version of ChatGPT. But the way that we're using it is, as you mentioned about our pipeline, typically when you're doing an investment memo, which is obviously very much required for us as fund managers, as investors, normally that takes days and weeks and months. Your associate or your analyst is gathering the data room. They're going to the data room of the potential manager or the company that's the target is being considered. Days and weeks back and forth writing an investment memo. We've tuned our version of ChatGPT, and we created a knowledge library as the basis. So we put our PPM in, we put our portfolio construction financial model in, we use benchmarking data from PitchBook and a couple of other things to baseline our knowledge library. That took 15 minutes. And so now when we do an investment memo, it takes 10 minutes. Yeah. And so the reason that's important for us is that it saves time. Again, we've tuned it because we understand the manager personas of our target managers. And we've tuned it to essentially, for me and my partners, all of our perspectives on how we think about risk and et cetera. That's important because when we're having LP conversations, we can move beyond just, hey, we have a pipeline and database of 200 managers. They generally fit in these categories. Although I know the data in terms of our 200 plus, about 85, 90% are US-based managers. The rest are Africa and Europe. But now the level of detail, if a LP has interest on, well, how many climate tech funds do you have in your pipeline, or how many agri-tech funds, we can actually go deeper now and provide that insight. And so when it comes to LP engagement, we're able to have much more robust conversations, particularly around our pipeline as a differentiator. And oh, by the way, it actually saves us quite a bit of time. So those conversations when we're having with LPs, and we're actually doing workshops and demos with LPs now because, again, we're giving it for free as part of the relationship. We want to help you enable and ultimately do speed up your due diligence on us as necessary. So we're actually doing workshops and demos with our LPs as well.
So you're valuable to your LPs not just for the money you can generate for them, but you're making them smarter with how to use AI to improve processes.
100%.
All right. And so AI, same question for you. Are you guys using it, or do you see an opportunity to use it?
Yes, we are using it, and it's never enough. We had a lot of things on the backlog yet. Seems like we are trying to introduce it to every conversation on the process on daily basics. But what I truly believe is what you were mentioning, right? The conversations are more efficient, and you can add much more value on the different conversations with the LPs. You can be much more productive and obtain much more returns from the time you have with those LPs.
No, I love that. All right, so I'm going to ask you to give some pieces of advice for the people in here who want to launch their own fund. So Miriam, what is something that the person who wants to create their own VC fund, in your opinion, needs to do after they leave this room? So they leave this room today, what is something you think they need to do on that path?
This is, to me, it's exactly like creating another company, like a regular company. You have to validate your market. You have to go to a niche. You have to believe in that niche. You have to have knowledge about that niche. I will say just start small. Sometimes people want to start with big funds, and it's really difficult to raise money for bigger funds. If this is your first time really being a manager, you still have experience, just start small, just to prove yourself, to prove your market, and also you trust your network. That's my piece of advice for this.
All right, Vernon.
Two things. Just like a founder, you have to really think about the problem that you're trying to solve. And it sounds oftentimes that, oh, I want to be a VC, I want to invest and write a check. It's much easier to write a check than to actually get a check back. And so you have to really think about the problem you're trying to solve and how to think through that full life cycle of actually returning that capital, because it just doesn't happen on its own. The other part of that is there's a lot of non-sexy, hard back office work that you have to do for compliance and auditing and tax. And that's almost as much of your time in making sure that all those processes and infrastructure are humming along, because when you get into due diligence and those things aren't there and you can't demonstrate it consistently, and unfortunately, we're in a position because we were managers ourselves, so we're peer investors, and we know a number of managers that are good at certain things, but that back office, they're just not as good, and it will end up destroying you in many, many ways, and you'll never raise a second fund.
I love hearing that. And one?
Please, not another VC fund. So maybe uniqueness, differentiation are key to add value to the ecosystem and bring a new perspective, a new way of supporting startups, and consider to be patient. Be fund managers. We don't know if we are good on what we are doing until 15 years after we started our VC fund, until we had a chance to see our returns. So be patient, enjoy the game, try to add value. So reputation and trust are fundamental to keep on going and to keep walking the talk, right?
Can I just add one thing to the trust factor? And that reminded me of, you really should respect your peers in the ecosystem, whether they're founders or other managers, because as a fund to fund, so obviously we're raising, so we're engaging LPs, but also as allocators, we've had in natural conversation other managers or founders that have said some positive things and not so positive things amongst their peers. And so the respect aspect is something we've really taken to heart, that if you have a bad reputation within the ecosystem as a manager or as a founder, that is something that we're over-indexing on. So you just reminded me of something about the respect and reputation.
Yeah, excuse me, just to mention something else is being humble, because in this game that we are still writing the pages of this book that is the VC arena, we're on daily basics, learnings, new ways or new approaches. So that is why I started saying that the topic is a big challenge, because we are always trying to explore and think of new ways of approaching. So try to be respectful.
No, I like that. So I'm a big Warren Buffett fan. So he says that, he talks about reputation. And basically it takes 20 years to build a reputation and 1 minute to ruin it. If you think about that, you do things differently. So keep in mind that reputation matters a lot. So I want to get into some real nitty-gritty, real talk stuff. If somebody leaves this room, decides they have the experience, they have a niche, they want to launch a VC fund, how much money realistically do they need to have in the bank to actually go and launch the fund?
Oh my God.
Let's get real. I mean, you got legal, but yeah.
That's a really complicated question. It depends of how much you really want to raise, right? But what you guys were saying, like raising a fund is a lot of work. You need to have people around you helping you. You can be the GP, the only GP, but you have to have other venture partners. You have to have, same as another company, marketing, accounting, the legal cost of all this. Like, Lawyers are brutal with this. So
I hope we don't have any lawyers
yeah,
in here.
yeah, I'm sorry, but you really have to, my main recommendation is that before you are actually launching a fund, just talk with other managers to recommend you lawyers and accountants. To me, accountants have been the worst, really, in overpassing the lawyers. I'm sorry if I have any accountant here, but oh my God, I have, for my own company accelerator, I have changed 5 times accountants. For this VC fund, I wanted to start kind of like good, but it's like it's difficult because we are talking about managing money from other people. You are responsible. You are accountable for for that part. So just talk with other managers. Do the math. Once you start this journey, you don't finish this journey until it exits. So it's what they said, it could be 10 years, 15 years. It's like, you have to really be sure and do like what you do with any other company. Do the math, do the projections, financials, and all depends how much are you raising.
All right, Vernon, give me some numbers.
Yeah, this is a good one. So, it does depend. I would roughly say if you're raising a $50 million fund, you need $1 million or $1.5 million. And that's depending on how much you're going to pay yourself or not pay yourself. There's travel costs, there's the attorney fees. Most law firms mostly would defer until your first close, so that's certainly helpful in terms of cash flow. But you still have maybe office space, depending on how virtual you are. But travel is going to be certainly a big cost associated with that, and maybe some vendor costs. But I would say maybe a $50 million fund, maybe it's $1 million, $1.5 million. But travel is probably going to be the biggest driver of that.
All right, those air miles add up. As much as we went through COVID, people still want to see you in person.
Yeah, because what we found is, our internal saying is in person always wins, because we're all on Zooms all day, every day. And it makes sense maybe for some initial introductions just to see if there's alignment of interest with your fund, your platform. But ultimately, if they like you and there seems there's alignment around allocation in your thesis and your strategy, in person just makes a huge difference because you're also building trust. And so the same thing for us, as I sort of flip it as allocators, in person, wherever, being in these spaces, it just makes a huge difference because you get a chance. And then obviously the human brain, and there's the limbic part of the brain and the emotional part that you want to activate. And normally that happens in person. And that's something that's very important.
May I add something
Sure.
there? Because the in-person is so important, and to continue that connection with your LP is so important, and for the new ones. Like in the accelerator, we do about 30 events per year, which is a lot. But in the VC fund, we do at least 1 event per month. We do lunch, we do Margaritas Thursdays. We try to also have fun a little bit, in between, and having these conversations in person, and having lunch, and not just, formal meetings when it happens, makes a bunch of a difference with people in LPs.
I love that. One,
Having said that, what we added to what you previously mentioned is we added newsletters, something really common, because there are some LPs that can be part of the conversation on daily basis, but are willing to invest, maybe having liquidity in 2 years, 3 years, that are willing to get up to date on daily activities you are doing. And besides the VC fund, don't let me lie, but we have so many things, so many chats, so many places we have visited in the last 30 days that you can write a book about what you have done on the last 30 days, right? So it's really important. Our newsletter is something that LPs are very grateful of receiving.
all right, so we're talking about fundraising strategies. You brought up the newsletter. A lot of people start with their own little angel fund. They're, a group of them, probably 5 of you investing. Do you think it makes sense to do a newsletter, even just about what you're doing, or even posting? Does it make sense to post something on social media, on LinkedIn, and say, I invested in this company, here's how it's performed, and then you eventually launch a fund? Or
David,
no?
I was tempted to add something to the previous question that was regarding the size of the first fund, just to share our story. and maybe it's more like a mindset, and it's the way we run our fund on daily basis, that is bootstrapping. The first fund that the fund managers who raised the fund was about 1.5 million, and it was a concept fund. It was a fund, and they had another job in order to pay the bills, you know. So, but they were committed on doing VC their life. So we are thinking on the next 40 years. So that is why we are so committed on daily basics decisions we are taking. And on those first 15 investments we did, we had 2 unicorns. So we are very proud about these figures, and we are very proud about the returns. Pitch would consider Draper Cygnus on the top deciles of the funds. But behind that, we are really committed on the long term. So maybe thinking regarding what is the size of the first fund, and there's an ego, something going on there, which is the side of your fund. I don't know. You need to start this game if you are willing to play it on the long terms, right?
I like that. So see what he's saying, $1.5 million. Don't be afraid to start small, right? 25K checks from 10 people gets it to 250K. 40 people gets it to $1 million. And that's still not 100, right? Most funds have a cap of 100 here in the US. So what else would you give from that standpoint? Does it make sense to try to use social media, the LinkedIns or so on, to get in front of LPs? Or is it, I've been a member of a family office association for 14 years, so we get to see a lot of funds that way. What is the best way, or some of the ways, that we should get it?
You have such great questions, because we talk about this as a strategy within the firm amongst our partners often, and ours is more around timing. And so there's sort of a firm perspective that being here, for example, we'll post, we're speaking at whatever. But we are being a little cautious on timing around our first close to align with that strategy. So we've revamped our website, so we're launching that. So we have a very, very deliberate branding and outreach strategy that we're going to be launching, but we want it to coincide with really a first close announcement. But we do have a very detailed strategy, very particular around that. And then I would also say the personality of the partners and the culture that you create within the firm, you certainly have a strategy that you want to have as a firm, but also you want to have a level of genuineness to bring out to enhance the partners and the people in the firm. And so one of my partners, Brian Brakeen, he's all about social media. Like he goes for the heat, he tweets and very much engaged, whereas Olin is a little more reserved in his engagement. I'm probably a little bit in the middle. So having said that, you got to think about your partners within your fund and your firm to allow for some natural engagement, whether it's social media or in-person conference type engagement.
No, I love that. And so in your case, Miriam, would you say that has been beneficial to use social media, whether it's LinkedIn or?
Yeah. So my background is I'm a graphic designer. That's my first, career. After that, I went to business. But I do all the social media for GSA Ventures. I have somebody for global, but for GSA Ventures, I do. I post every day in LinkedIn. I post every day in Twitter, Instagram. With my partner, we do blogging every week, the same time, same day, So it's consistent. We do newsletter. Like we do, again, this is like running basically a company, like regular company. You have to do the outreach. People need to know about you, especially if you are raising. At the beginning, when you are raising, you are connecting with a lot of other people precisely because many people are going to tell you no. And you gotta connect with way more people, and outreach. And that is when it comes the second line of connections, right? And that, social media amplify a little bit the message of what you want to pass. It's not going to sell. It's not going to do the final sell, but eventually. But it does amplify the message for what you do.
All right, no, I love that. So going back to another nitty-gritty question. So 2 and 20 is what we've all been used to in the asset management world and out. So private equity, hedge funds, VC funds, 2% management fee, 20% performance fee. Usually there's a GP commit, the general partner puts in some money, 1 or 2%. Has that been changing? Is 2 and 20 out the window and is now 1 and 15? What's happening?
No, because this is our first fund, we wanted to put it as vanilla as possible. So, and the standard as possible. So we will have less rejection over the standards of the terms. You know, when you have probably third or fourth fund, you can be a little bit more creative and, you know, do some other stuff. But my recommendation is to go vanilla as many other funds. At the beginning, I think is for us has been good, just the standard.
You're a fund of funds, so a little bit different there.
Oh yeah, fund of funds. We've heard a lot of. We don't invest in fund of funds. Why not? Because of the fees. There's double redundant fees. That is not our case, and that's why the size of our fund was very deliberate and intentional in terms of being data driven for that number, and as a hybrid investment model to invest in both managers and direct. So typically, if you're investing in direct opportunities, sometimes you can sort of dictate the fee structure. But we were very, very cautious. So the quick answer is we're 7 and 7 in terms of our fee structure. But all in for our LPs, if they were investing in the 50 fund managers that we're investing in, it would be 2 and 20, it'll be the same. And again, we're able to do that because of the hybrid nature of the fund structure to allow for that. So we want to enhance and ensure from a risk-adjusted standpoint that they could get to those managers. We'll give them access and engagement, the co-investment opportunities. We're not charging for that as well. But 7 and 7 is essentially our number.
Okay. And then 1, your fee structure or what do you think is happening?
2% is okay. We just want to pay the bills. We don't want to live from that 2% at all. We are ambitious regarding the other 20. That is where we put our attention. In many cases, we heard that there are some VC funds asking for 3%, and I feel comfortable regarding our track record to start other kind of conversations, but we don't put energy where we do not need to. So we are committed to our 2%, and we give early investors in our funds a premium to maybe have 1.5 or something like that.
All right, so Vernon.
Just one clarification. 0.7%.
0.7. When he says
Right.
7, that's
yeah,
7.
when I said 7,
0.7.
I want to make sure it's 0.7. So and
Very,
7%.
very important. That decimal makes a huge difference on the returns. All right, so Vernon, you use a term that some people in there may not be familiar with. You talked about a first close. So please just explain to the audience what is a first close, and then I want to hear if they did first closes or just went straight to one close.
So the first close is your first formal close of the fund. So if you have a $50 million fund, for example, you get $10 million in commitments from LPs, you can have a formal first close. And at that first close, you can now start taking management fees, which is, as an investor, as a manager, you can start paying yourself from the management fees. Typically, you can have rolling closes. So you can, depending on the amount of commitments you have from LPs, you can roll those commitments. Sometimes that's good, but there's attorney fees that happen with rolling closes. The other option is to just set very specific targets for a close. So you have your first close, maybe there's a second close, and your final close. And again, these are formal documents being signed and executed with your LPs. All the LPA agreements, all of the things are being executed at that point. And typically, again, depending on your fund, you have 18 months to 24 months to get to your final close following your first close. So the clock really starts at that point. All of your metrics and all of those things from a fund standpoint all happen at that first close. So you need to make sure your pipeline, your timing, all of the back office things that we talked about earlier, when that first close happens, it's formally off and running.
All right. Did you have a first close or you just?
Yes, I did. It's a small fund, but we still have a very small first close. And we got the target, and then we wrote the first check. Our rush was more than the management fees because it's such a small fund. was to write the first check.
So you had a deal that was live and you wanted to close, and you used that to push the LPs. Hey guys, we're going to miss the date. Write the check.
Yeah,
Right. So guys, when you have bait, use the bait to close.
FOMO, yeah.
All right. FOMO. One.
Just to mention that Vernon described perfectly well our VC fund because we are raising a 50 million and we did an initial closing.
And I didn't
of
know,
10.
really. I
Yeah.
really didn't know. That just happened.
And we did an initial closing of 10 last week, and we have two companies that we are almost ready. We have been doing the deal flow, and we are very excited of investing in them. Just to mention that when you are on your fourth fund, that management fee you proportionally assigned to those costs that are previously been taken by other funds as well. So you start trying to pick up those advantages.
All right, no, that's excellent. So I really want to make sure we're in the nitty-gritty because the people in here I care the most about are the ones who want to launch a fund. So when you talk about management fees, so this 2% of the assets under management come to you. How often is this money coming? And can you use that money to help cover the cost of what you had spent early on to go and pay the lawyers and pay the accountants?
Yeah, proportionally you assign to the new fund those costs because you might be having different LPs, so you have to be very, very, how do you say, prolijo? Very polite in handling that money. And we have 4 capital calls in the next 4 years once an LP had committed the money that will be deploying, because you are not going to use all that money at the same time.
So guys, for those who don't know, a capital call, right? You raise a $50 million fund, you don't have $50 million sitting in the bank. That's not how it works. They've committed $50 million, and it's not for the whole 10 years. It's usually probably the first 5 or 3 years. They're going to 4 years in his case. So 50 million, you have 4 years to deploy the 50 million. They are sitting on the money, and you need to literally call, a capital call for the money. You're doing fixed calls, 1 call per year for 4 years.
Yeah.
But there are options where you might have capital calls based on a deal. How are you doing yours?
Yeah, we base on the when we feel like we are going to be funding the startup. So we have a schedule like spring and fall time. Now, not because you schedule, you may have a hot deal in the middle, and maybe you need to do an extra capital call, but it's more to manage the expectation of the LP, right? When do I have to give money again? And if you said you have like 2 capital calls per year for the 3 first years or something like that, double down in the 4 years, something like that, then they know more and less what to expect. So this is how we are managing.
Love that. Vernon?
Yeah, same. We're 4 times a year, and so the cycle and the dates.
Quarterly.
Yeah, and so we're communicating. Even in our documents, we already have here the dates of the
How
capital
much
calls.
advance notice, if you have that surprise middle one, the third one of the year, is it 45 days, 30 days, 14 days? How much notice are you giving that LP that there's a hot deal?
It depends because, if the startup is maybe, closing around and you are kind of missing the opportunity to enter in a very good terms, it could be 1 month that you have to raise the capital call and continue doing, the deal. Sometimes I have startups that they tell me way in advance, hey, I'm going to start raising my funds. I already have committed for, this much. And I may have 2 or 3 months, But usually I just have one that I have to rush up like 1 month.
All right, start preparing your questions. We have 12 minutes left, and I want to just ask one more thing around those capital call side of things. When you go and do that capital call and you're short, you didn't get all the money, for whatever reason, life happens when these LPs make commitments. Are you using venture debt? Is it coming out of your pocket? How are you covering that tranche to ensure you get the full amount? Or do you just say, hey, I was in for 250, only 200 came, so I'm only in for 200?
Again, our checks are small because we are a small fund, right? So we are writing 60K to 100K checks. The first check we have to give was for 60K for a startup. He basically almost completed the pre-seed round, and at the time I just have 45. And so we enter into agreement that, okay, it's going to be 45, and we may do a double down going forward, depending of how the rounds are coming up.
Okay. Ever been in that position?
So we have lines of credit with the banks, and most of the larger banks have specific programs for capital call. So really it comes down to who's offering the best terms, but we have a line of credit specifically, a capital call line of credit to cover any shortfall or timing.
One?
Not much to add.
No. All right. I love that. All right. So 11 minutes left. Please, questions. You have people up here that are willing to be very transparent about what it takes to launch and run a VC fund.
And bring some strategies as well, please.
Yeah.
Hi, I'm Daniel Dudley, serial founder and operator. So with someone like me who doesn't have a traditional investment banking or finance background, what kind of advice would you have for me who's like a first-time founder, or sorry, first-time fund manager?
So first-time fund manager, not from a finance background. Sounds like you, the graphic designer.
Yeah,
You, Miriam.
yeah, that's me. I'm more like the business mindset. Get a venture partner. That is the financial mindset. Like my venture partner, for example, he used to work with the Toronto Stock Exchange for 7 years, very knowledgeable in M&As and IPOs. And this is the guy who is leading that part in the firm.
I love that. Vernon?
Yeah, I would say the same thing. Partner with someone that has more experience and understands the cycles of investment cycles, so you can complement one another. But besides that, there's also a concept, an idea we call synthetic track record. So even if you haven't been an angel investor or you haven't been an institutional investor per se, what are the areas of success that you've demonstrated in your professional career, either as an operator, as a founder, whatever the case is? We're looking for this synthetic track record to be able to give you credit from that standpoint towards your investment track record.
All right. And one?
Difficult to add something new, but bring someone that is better than you and be confident on your value. Yeah, this is a business people business, so try to be confident and build your network.
All right. So partnership. Don't be afraid to bring partners. All right. We got two in the front, one back here. Oh, all right. We are getting questions. I love this.
Hi, my name's Debbie Irwin. I run a founder development organization and startup accelerator in Virginia since 2012. We're looking at building a fund to start deploying for ongoing support of these founders, but it changes the relationship with the founders when you suddenly have the purse strings as well. So what are your recommendations when working with founders when it comes to still keeping the vulnerability and authenticity with those founders, making sure they're fully supported, but then also holding the purse strings and starting to deploy funds?
Who you want to start with that, Miriam? Because you really
Well,
deal with
I have the
founders.
same case, right? I have an accelerator and I still have the accelerator. And I think that change is actually good for them. They perceive that change as a good thing. And actually, I have startups from the accelerator that became my first LPs, So it could be an opportunity for them to also wear another hat and become investors for you. I think having a transparent conversation with them, saying we are going to have a venture capital fund, from the 300 startups that I have, many of them are not investable. They became very good friends, and I have to tell them that, hey, I love you, but I'm not going to put a check on you. It's kind of like the transparent relationship. You are not investable company. Maybe you want to become an investor and actually invest in companies that are going to have a good track record. But if you have a good community and good relationship with them, I think you can have those honest conversations with them.
Honest conversations. Anybody else want to answer?
What part of Virginia?
Oh.
Okay, I live in Alexandria and originally from Hampton.
So Lightship and Lighthouse linking up. I like that. And then one?
Yeah, just to mention that if your brand and your community is evolving organically, then it's okay if you are willing to raise a VC fund. But my message to the whole ecosystem is try to find something you are willing to be the best in and not trying to be everything at all. Because I find a lot of players in the ecosystem that are willing to have an angel club and then an incubator and are willing to be a VC fund. And then that is a mess because we are all expecting everything to have all, and it's not the case. You just need to pick something and try to be the best in that. This ecosystem is very collaborative, so if you are a incubator, you can contact the best incubators in the world and they be willing to be mentors on it. So try to find something you're willing to be the best in. Okay.
Sorry, may I add something very quick that I did in my accelerator? I put an extra program for them to understand investment from the investor perspective, and many of them understood why they didn't get funded.
No, I love that. So as you point, I'll point out a book if you want to write it down. David Rose wrote a book called Angel Investing, and I think that's a great book as a founder to understand how founders think, but also what actually goes into running a fund, how you set up the fund. More from the angel investing side, but very good. I knew we had 2 more questions, so there was one back here, one here, and then another question. So 3 more questions.
Hey, this has been a great discussion. Really appreciate it. My name is Ben Pigeon. Been running an angel group for about 9 years. I've gotten some brain damage from leading some rounds, and I probably have looked at 3,000 some odd deals. I think we fund maybe 15% of the applications that come in. So we need to evolve into a committed fund. And so I'd hope that you'd help me out with a little bit of ICP, kind of taking this comment that you said that we need niches to focus on. We've been more opportunistic. So what are your LPs asking for that you have poor coverage in, and where are VCs not focused on today? Oh, wow, that's interesting.
Where are no VC focusing today?
Well, any niche you think he should be looking at?
There are. I think there are so much. There is so much gap in the market. Really, there are VCs that are being very generalistic, and I think that that's what is driving the market down. Is because you have the same thesis and opportunity as any other VCs. So it depends, you can go to particular sector or particular, your thesis is going to make you different, and you have to see if there is any others with similar thesis. So you see if you are actually bringing something that is more like good for the ecosystem, right? Like in my case, for example, I work with immigrants in technology. There are several, funds that are immigrants in technology. So I have to gotta deep down, in my thesis and be more unique, until I got to the Moneyball strategy for immigrants in technology. Like it has to be super niche at the beginning. And this is how, your LPs see a value on your network. And if they resonate what you are saying, of course, you create like a very powerful community.
I love that one.
Yeah, just to summarize, say, be contrarian. Find something unique and go for it. We started doing deep tech in Latin America in 2012 when people didn't understand what was deep tech, and even if there was an opportunity in Latin America. And we are now raising our 4th fund, and we cannot be more proud about it. And we are thinking on the next wave, always. So find something that you embrace no matter what people had to say.
All right, so be a purple cow. I love that. Up front and then in the back, and then we can wrap this up. Oh, she's right there.
Sorry about that. My name is Ivan. I currently work for a PE firm, but in the future I would definitely want to start my own VC fund. My question is, if you get into too many terrible deals as a VC fund, how do you work with your LPs or communicate so that they can maintain the trust and the confidence in you to actually respect the capital calls or even invest in future funds that you're going to set up?
I came from PE and I still do PE, so I would say don't leave it. But I love that question, so.
You said terrible deals, right? Okay, so that's bad. Like you're not going to have a second fund, probably. That's why it comes. Everything comes to data, really. If you see the LPs, people that have actually the money to put money in a fund, they can put money in a traditional financial portfolio. They can do real estate. Like to put money in your fund is because they are going to get way more return of investment than a traditional portfolio real estate or any other investment, right? So if you have bad record from that, it's telling you like, okay, like I really didn't put my money in the right place, right? So this is why if you are starting the fund or you're starting to see some signs that the companies that you are selecting are not good, you gotta be hands-on, put skin in the game, and help those companies to do better. Try to find partners in the market to see how we can improve the quality of the companies. Because really, I work with startups. You don't see my gray hair here, but I really it's a lot of work with the startups, and you cannot be just passive, putting a check there, waiting for them to do something. You have to help them also to do the next step.
All right, so I feel that's a PE question, the way you phrase it, right? LPs who invest in venture know the power law, right? You're going to invest in 15 companies in the portfolio, 10 of them are going to fail. And they know that, and you don't know which 10. 3 are going to return exactly $1 for the dollar that you put in, which means you lost money over time value of money. Or the remaining 2, one is Facebook. They know that. So they won't look at it as, oh, you put me in 2 terrible deals. They're going to ask what's happening to the other 13. They're going to be a little worried, but they know that 10 are going to fail. Private equity, which is where I started, that's not how we look at it. Every single company in our PE portfolio is expected to actually generate a return, but they're already profitably existing businesses. VC is completely different when you go to the LP. So I don't think you have to worry as much, but you can also hedge a little, right? The first 3 deals you do, make sure it has a big lead and you're just jumping in with a small check. And say, well, if they did it, why are you going to shoot me, right? There was an old saying that IBM, you don't ever go wrong, you don't get in trouble for buying IBM if you're in the tech department, IT department. So if you can say, well, Sequoia was in there and I was in there too, they made it, the big guys made the same mistake I made, nobody holds it against you. That's what I would say. Anything else before we get last question? In the back there's, and then in the front. Yeah, we have the 42 nurse.
Hi, my name's Kaushik Imari I help run Purdue's Startup Accelerator program. My question is primarily to you, Juan. You're talking about raising a first fund, and you talked about your journey where some of you all didn't have sufficient management fees to pay yourself a salary, and you had to kind of do a full-time job on the side. I'm curious, how did you manage time, considering that you're so busy as a VC, and this is a world where you kind of have to be everywhere all at once. And I'm curious if that was a path that I wanted to take, what would you recommend?
Thank you very much for your question. That example was regarding the Cygnus, which was in 2012. There were 2 fund managers in that moment. And just to mention that the 5 of us, we are entrepreneurs. So we like doing the hard work.
All right, I love that. Last one, this is from 42 Geeks. 42geeks.com, by the way, check it out.
Yeah, thank you. I'm Doug Song. So we have a family office, and we're investors in dozens of emerging managers around the world. To the earlier question, if someone else had, we do also look at sector, thesis, geography to distinguish that. But one of the challenges we find in all these places is, again, it's highly uneven in terms of manager experience or education. So we are trying to find some ways to help support emerging managers. For us, the emerging manager portfolio is kind of like our scout kind of program, right? So they do those investments. We look to follow on, right? It can come alongside and after. But we are looking at maybe a philanthropic kind of aspect to it. And so there are some interesting DAF structures, at least in the U.S. for how
Donor advised funds for DAF, for those who don't know.
And so there's a program with Milken, with a friend that we have who's now trying to set this up, about a $100 million fund there, with potentially foundation money. We have a foundation as well, to help support emerging managers, because you can't eat on like a $5 million fund or whatever. And so a little stipend, maybe some VC training. So I'm curious about whether any of you have had any experience or perspective on these VC training programs. VC Lab, Material Change, Cool Water Capital, and whether you recommend them for emerging managers.
Vernon?
Thanks, Doug. Great question and driving the point home. I think those programs are helpful, but really you have to be an apprentice. Like to be a really good investor, you need an apprentice. So someone who's really done it and gone through those cycles and deal structure is really important. So I certainly encourage people to go through those programs, but ultimately to really de-risk your capability, you need to be an apprentice and work closely with someone that has invested previously.
All right, amen. We are at 0. I think we got great questions, and I hope you enjoyed the panel. Thank you very much.
Thank you.